This video will provide a walkthrough to the solution for exercise 7.1 on equity investments. Here's the data for our problem. On January 1st, Maverick Company purchases 500 common shares of Western Limited for $50,000 cash plus a 1% commission on the transaction. On September 30th, Western declared and paid a cash dividend of $2.25 per share. And then at year-end, the fair value of the shares was $108 per share. Then, in early March of the following year, Maverick sold the shares for $57,000, less a 1% commission. Now, the shares are not publicly traded, so Maverick will account for them using the cost method, and Maverick follows ASPE. So there are 4 requirements for this problem. First is to describe the type of investment and how it would be reported. Second is to prepare the journal entry for the purchase, dividends received in the sale, along with any year-end adjustments if required. Then for requirement C, we're going to assume that Maverick follows IFRS, and the investment in shares is accounted for as a fair value through net income or FVNI investment, and prepare the same journal entries as in requirement B. The last requirement asks us to consider how our answer to requirement C would change if Maverick follows ASPE and the shares are traded on an active market. Requirement A asks for the correct classification for this investment. In this scenario, the investments would be classified as equity investments at cost, less any reduction for impairment, because these are equity investments that are not publicly traded. They could be reported on the balance sheet as either current if management intends to sell them within 1 year, or a long-term asset if management intends to hold it. Now on to requirement B for the journal entries. The first journal entry will be to record the purchase of the investment on January 1st at its cost. So we're going to debit an account called Other Investments or something similar for $50,500, and we'll credit cash for the same amount. The calculation is the $50,000 cash price plus the 1% brokerage fee, or $50,000 times 1%, which means the brokerage fee is actually $500. The next entry is on September 30th when Western declares and pays a cash dividend of $2.25 per share. So we will debit cash and credit dividend revenue for $1,125, calculated as 500 shares times the $2.25 per share dividend. Now, chronologically, the next date would be the year end of December 31st, where we're asked to record any adjustments if required. Under the cost method, there are no adjustments to the investment required since the investment is carried at cost and is not adjusted to fair value, which then takes us to early March. I'll put in March 1st, where the investment is then sold. So first, we're going to determine the cash proceeds on the sale, which is calculated as the $57,000 proceeds less a 1% commission, or $57,000 times 1%, which results in net cash proceeds of $56,430. This means the brokerage fee is $570, or 1% of $57,000. Now I'll leave a space, and then we will credit the other investments account for its carrying value at cost of $50,500. There's no calculation required for that because that's what it's carried at. The difference between the two is any gain or loss. In this case, the debit to cash exceeds the credit to the other investments, which means we have a gain on sale of investments, which will go to net income of $5,930. That's calculated as the proceeds of $56,430 plus the $50,500 cost. Now on to requirement C, where now Maverick is assumed to report under IFRS and classifies the investment as fair value through net income, or FVNI. On January 1st, we will record the purchase of the investment. This time we're going to debit an account called Investment in Shares, FVNI, for $50,000, not $50,500, because the brokerage fee of 1% or $500 is not added to the cost of the asset under IFRS. Instead, it's expensed separately. So we will debit a brokerage fee expense for $500. The credit to cash is still $50,500 as it was under ASPE because that's the total amount of cash paid, $50,000 for the investment plus a $500 brokerage fee. Next is the September 30th dividend payment by Western, which is exactly the same as the treatment under ASPE using the cost method. We will debit cash and credit dividend revenue for $1,125, calculated the same way. Now we reach December 31st at the year end, where under IFRS for an FVNI investment, we're going to adjust the carrying value of the investment to its fair value. That's what FV stands for, fair value. So we're going to debit the investment in share account for $4,000, calculated as the $108 per share fair market value, less the $100 per share cost, multiplied by 500 shares, which equals $4,000, and credit an unrealized gain on investment for $4,000. And then the last entry is the sale on March 1st, we will debit cash for the same amount as previously, $56,430, again calculated as the $57,000 value of the shares minus the 1% brokerage fee. Now under IFRS, the brokerage fee is also expensed separately. So we're going to debit brokerage fee expense for $570, which is 1% of the $57,000 fair value of the shares. I'm going to leave a space and then credit the investment in shares account for its current carrying value of $54,000, which is the original $50,000 cost plus the $4,000 fair market value adjustment from December 31st. That's a total of $54,000. Now we have more credits than debits in our journal entry. For the entry to balance, we need a credit of $3,000. Therefore, we have a gain on sale of investments, which goes to net income of $3,000. And finally, for the last requirement D, we're back to a classification under ASPE, and this time we're to assume that the shares are traded on an active market. In this case, under ASPE, and if the shares are traded on an active market, they would be classified as short-term trading investments at fair value through net income, or FVNI, just like IFRS. Therefore, the journal entries are identical to the IFRS entries we just covered in requirement C, including any adjustments to fair value at an intervening year end. And that's it. The problem is solved.